In this video, we're going to look at the fixed manufacturing overhead variances and the related journal entries. Let's start by looking at our overall variance worksheet and picking the relevant information out of it. We can see that our static budget and our flex budget both show $60,000 for fixed manufacturing overhead. As a review, this is because the only difference between the static budget and the flex budget is the volume of units that we're talking about, and fixed manufacturing overhead should not change with volume. However, we're still going to have to create a predetermined overhead rate. So we have $60,000 of fixed manufacturing overhead divided by 10,000 jogging suits times 2 hours per jogging suit gives us a predetermined overhead rate of $3 per direct labor hour. The other relevant piece of information on this worksheet is the actual results. We actually spent $55,000 on fixed manufacturing overhead. Okay, let's move on and put this into our familiar format. Again, notice that I have taken the actual box, gotten rid of the formula, and I just have actual in there for the same reasons as I explained in the variable manufacturing overhead video, that this is made up of a lot of different things: rent, taxes, supervisors' salaries, etc. And there's no good way to say that there was an actual quantity times an actual rate when you're mixing together 4 or 5 completely different items. We know from looking at the numbers just a minute ago that our actual costs were $55,000. Now, the middle box, the third budget, as I called it in the other 3 variances, I have also eliminated the formula from. And so fixed overhead variances are different from the other variances in a number of ways, and this is just one of them. This is the budget amount. Which budget? The flex budget? The static budget? It doesn't matter, does it? In both cases, that amount is $60,000. Now let's look at the difference between those two amounts, which is $5,000, and this is favorable. We spent less than budget, so it's a favorable spending variance. But that budget, that middle number this time, is our flex budget. And so this number is also our flex budget variance. So remember, in all of the other variances that we did, we added our 2 variances together or netted them together if they were different signs, and we came up with our flex budget variance. In this case, the left-hand number only is the flex budget variance. That's one of the big differences between the fixed overhead variances and the other ones. Now, on the right, I have applied. We're still going to use the same formula, but I'm going to call it applied here. So it's our predetermined overhead rate of 3 times our expected quantity, which was the 24,000 direct labor hours. So this is the amount that we actually applied. This is not going to show up on that overall budget anywhere, but if we applied things on the basis of $3 per direct labor hour, then when we put 12,000 suits into production, we would have expected to apply $72,000 of fixed overhead. So when I take the difference between our budget and the applied, we have over-applied fixed overhead by $12,000. This should sound similar. We talked about over-applied overhead in previous topics. This is a production volume variance. It's a favorable production volume variance because we made more units than we had planned on making, and that ultimately increases our profit or our operating income, net income, but it's a production volume variance. This is not part of the sales volume variance. This variance is out there all by itself. Okay, now let's take a look at this compared to that overall variance budget worksheet that we did. So we're looking at the fixed manufacturing overhead line. We can see that the actual costs match, the budgeted amounts match in all 3 places, and that flex budget variance, $5,000 favorable, matches, But the production volume variance that we have on the right isn't on this worksheet at all. That is a separate variance. Okay, let's go on back and do some journal entries. So the first journal entry will be to debit manufacturing overhead and credit accounts payable or whatever else it may be, cash, for the amount of the actual bills, invoices, whatever we get during the month, taxes that have to be paid, rent that has to be paid, all of those items. So this is many journal entries again, just like the variable overhead would have been. The next journal entry will be to apply manufacturing overhead to work in process. And we figured out how much we're going to apply. We're going to apply $72,000. Now, if you think about this as every time they start one more jogging suit, they apply $6 more because they're going to use 2 more direct labor hours, then every time, so let's say they start a batch of 100 suits, they're going to journalize an application of $600. And eventually they have over applied this by the $12,000 that we see. Now again, if we put this into a little T account, we post the $55,000 actual on the left, the $72,000 applied on the right, and we are over applied by $17,000. We have to close out manufacturing overhead. We are going to do that with a debit to zero out this account, and my credits will be to fixed manufacturing overhead volume variance, the $12,000 volume variance, and the spending variance. So our manufacturing overhead is now back down to zero, and we have balances in our fixed overhead variances. That's the end of this video. In the next video, we're going to look at how we close out all of the variances at the end of the year.